Okay, everybody, you're very welcome. As you might see from the screen here underneath me, my name is John Casey, and along with my colleague Aisling O'Mahony, we run the Academy for Investment Fund Executive Education and Development, or the Funds Academy for short. And also with us on screen here is Owen Walker from the Financial Times. This is the fourth in our series of monthly seminars on terms that we hope are of interest to those of you working and hoping to work in the funds industry. And we would really love some suggestions from yourselves. If you have any other suggestions for further topics, please email myself or Aisling, or just pop something into the chat function whilst on this webinar. Just by way of background to ourselves, the Academy for Investment is the Funds Academy. We've been established with funding from the Higher Education Authority. Our main activity is to run a Masters in Investment Fund Administration, which started last month, and we're currently accepting applications for September 2022. It's a long way away now at this stage, but get your applications in early if you're interested, and that'll be offered in both MTU and in WIT. Details on this and all of our activities are on our website, www.fundsacademy.ie. Today then, what are we up to? Well, we're delighted to have author and financial journalist Owen Walker with us. This session will follow a Q&A type style. Don't worry, there won't be any awkward silences while we try and fish for questions. Myself and Aisling do have a series of questions simmering away on the pot. However, we would be delighted to put your questions to Owen as well. If you want to ask Owen a question, please use either the chat function or also use the Q&A function there at the bottom of the screen in front of you there. And the only difference between the two really is that the Q&As are just shared amongst myself, Aisling, and Owen, whereas the chat may be a bit more public. We promise to be finished well by 1:30, and again, as Aisling has pointed out, we are recording this session. So just by way of housekeeping, you're probably clear enough that this is a Zoom webinar as opposed to a Zoom meeting, and on joining this, your camera was not turned on and your sound was muted. So, feel free to eat your sandwiches. We're not going to hear you munching away in the background. And as noted previously, please use the Q&A and chat function. Today's topic then, well, we're going to be talking a little bit about the collapse of the Woodford stable of investment funds. We'll delve in a little bit into the circumstances that surrounded that collapse and the fallout that is still ongoing today. And just remember that the tipping point for the Woodford Fund happened, I think it was about June 2019. It's getting not quite there yet, but it's getting close to 3 years now. And we now have the benefit of some hindsight, and thanks to Owen, a great insight into what's occurred as well too. So hopefully we'll get to look at some of the lessons that can be learned and any potential changes that might emerge as a result. So to our guest then for today, Owen Walker. Firstly, a shameless plug for Owen's book. Here we are. There's my built-in eye. It's The Rise and Fall of Neil Woodford and the Fate of Middle England's Money. I suppose it's a definitive account of the collapse of the Woodford stable of investment funds. The book is really well researched and offers a great insight into the events surrounding the failure. The tale is told with colour and precision as Owen expertly navigates the complex world of investment fund management. It's a really good read. It's not dense. It's you don't have to be anyway expert in the industry. It's a fantastic piece of work, and it's told really, really well. Also, I think given current events that we're in, a plug for Owen's other book. This is Barbarians in the Boardroom, I plug this now, I suppose, because of current events that are taking place with Vodafone, where there's a group of activist investors, I suppose, trying to shake things up inside in Vodafone. Barbarians Boardroom is a really good analysis of activist investors, hedge funds in the main, and how they've become to be both feared and respected, maybe in equal measure. Owen himself then is currently European banking correspondent at the Financial Times, having previously served as asset management correspondent and deputy editor of FTFM, the FT's weekly funds management supplement. In 2020, he was named Joint Business Journalist of the Year at the London Press Club Awards, and I guess there's nothing like the grudging respect of your peers. So that was a great honor. And then more recently, he's been writing about, I suppose, even just in the last couple of days, about the risk exposures that many European banks face in the Russian market, and the potential knock-on impacts of any sanctions that might be imposed over events, or maybe, well, I won't say likely events, but potential events in the Ukraine. Also, wearing one of his other hats, he was co-founder of the Association of Member Nominee Trustees, having served as a member-nominated director of the Pearson Group Pension Plan. That's a £2.5 billion pound hybrid pension scheme, and Pearson were the previous owners of the FT before selling out to Nikkei. Okay, so I suppose our first question then, maybe just to get the ball rolling, and for the benefit of those who might not be too familiar with the Woodford collapse, perhaps, Owen, you might paint for us and say broad brush strokes some of the events leading up to the demise of the Woodford stable of funds.
Absolutely. Well, before I do, I'd just like to say thank you, John Ashton, so much for having me along today. I think the work you guys do is really great, and I'm just delighted to be involved in this. So thank you for inviting me. So the Woodford investment, I'll just do a very sort of brief overview of the story running up to, as you say, June 3rd, 2019, which is when this whole kind of scandal really blasts open, if you like. So Neil Woodford was, up to that point, the best known UK fund manager, arguably of his generation, and pretty much one of the most successful. He started his career in the 1980s. I get into a bit of the background of his early life in the book. He hadn't particularly wanted to get into fund management. He kind of fell into it by accident. He wanted to be an air pilot. But he kind of got the bug in the 80s. You hear a lot of people of that age, he's in his early 60s now, who worked in the City of London in the Big Bang era. It's a very exciting time, lots of deal making, lots of change, lots of international finance. London became this big center of international finance. And he kind of he got the bug there, if you like. He didn't stay in London too long. He moved to an investment company based in Henley, just outside London, on the Thames, very picturesque town, called Perpetual, which was a kind of a group of renegade fund managers. They kind of did things their own way. They didn't subscribe to the kind of the group think as they saw it in the City of London, and they were in this little bubble, and they lots of very impressive, very forthright, single-minded fund managers. And he really thrived in this atmosphere. It was a small group, but he joined in the late 80s, and over 25 years in that time, not only did Perpetual grow to become one of the UK's biggest fund managers, and it was eventually bought by Invesco, this huge US investment company, but Woodford himself, his reputation grew. No one had heard of him when he turned up at Henley in 1988. By the time he left in 2013, as I say, he was the best known fund manager of his generation. His brand, Woodford, Neil Woodford, as an individual, what was bigger, if you like, than Invesco, Perpetual, the company he had worked for. There'd been a survey shortly before he left, which looked at brand recognition within UK investors and financial advisors, and it was talking about brands as in Invesco or Fidelity or Schroders, these big fund company names. He came number 3 in that, his personal Woodford name, and he hadn't even set up his own business yet. So this was the size of the guy. How did he do that? How did he make his name? Well, he was this one of these group of so-called star fund managers, where they were heavily marketed by their companies. They received lots of press coverage. They happened to be very good at their job as well, so they often went on these sort of stellar multi-year winning streaks, where they would kind of trump the market, become have the top fund in their category, and everyone would laud them as being these kind of investment masters of the universe. He really forged his reputation on 2 near-death experiences, if you like, for his career. The first was in the run-up to the tech bubble bursting in 2000. Right the way up into that, throughout the 1990s, he'd been investing in what a lot of other people would call maybe stodgy companies, big dividend paying companies, FTSE 100 blue chip companies, tobacco companies, pharmaceuticals, companies which weren't known for fast growth. They weren't particularly exciting, but they could be depended on to pay those dividends. And that's really what he specialized in. And so he invested in those companies. Everyone else at this period was doubling down on tech stocks. That it was the tech bubble. Everyone saw these, these companies which basically were URL. They're a website with not much else, and they had these sort of multi-billion valuations, and people just pouring money in. And he saw it for what it was, emperor's new clothing. He just thought it was completely fantasy money, and he wanted to stay away. He wanted to keep the money he had been entrusted to manage away from that. He saw it as big danger. Um, but as everyone was piling in, these valuations became so inflated. Everyone else's funds were doing spectacularly well. His was lagging. His was losing clients. People turned their back on him, saying he's a laggard. He isn't following the trends. This new sort of tech bubble. He's not convinced by it. And as I say, in the early 2000s, he was losing customers. His fund was underperforming compared to competitors, and at the same time, the business he was working in, Perpetual, was in the process of being sold to Invesco. He was getting a lot of pressure within that company to actually, come on, Neil, add a few of these sort of tech stocks. We all know they're a bit dodgy, but if you put them in, your fund will do a bit better, and we can all kind of like, make sure that the deal goes ahead. He firmly resisted this. He's a very dogged, he's very obstinate guy. He said, no, I'm not going to do it. At that point, he really felt like he was going to be fired, and that he would kind of go down in a ball of flames and no one would touch him again. He survived. The bubble burst. Tech stocks just cratered. They went through the floor, and his fund was completely untouched by that carnage, and it kind of came out like a phoenix. It survived. Everywhere else was just in flames. So that was the first and probably the biggest test of his career. He kind of repeated the trick again to a lesser extent in the run up to the financial crisis. He avoided banks, he avoided financial stocks in the run up to that. Obviously, a lot of people were, and we all know what happened there. And again, his funds came sailing through, and so he really attracted this reputation as a kind of soothsayer, someone who had the Midas touch, who could look at the market and say, look at the danger points, 10 paces ahead, and completely avoid them. So by the time he left Invesco Perpetual in 2013, he was managing 33 billion pounds. Arguably, and if he was a fund manager himself, he would be one of the top 5 fund managers by assets in the UK by that point. Huge amounts of money in just a couple of his funds that he ran. He fell out with the team there. He bought by this American company. He fell out with the Americans there. He wanted to do things differently. He personally, he'd kind of been doing this for 25 years. He actually felt he was more interested in not these big stodgy dividend FTSE 100 blue chip companies. He was much more interested and excited in startups, in science-based companies, in companies that were very small, that hadn't listed yet or had only just listed but still needed funding to keep going. And he thought there was a real opportunity here that he could take advantage of. Invesco said, no, stick to what you're good at. That seems a little bit risky. He fell out with them. There was a whole range of reasons, but this was one reason. He wanted to go off, set his own business up, and sort of dedicate himself to this small area. But in doing so, the only way to set off and make a success of his new launch, he had to convince people to bring that money over from Invesco. So what he did was he replicated his funds that he had at Invesco with his new company called Woodford Investment Management, which he set up in early 2014. These funds were designed to replicate exactly what he'd done before, come in and bring in billions of pounds of savings. And that's exactly what happened. And in those first few months, he attracted £5 billion of UK investors' money, which was the most successful launch of a fund management company ever in the UK at the time. And it was a stellar start. And within a couple of years, the money just kept pouring in. And within 2 or 3 years, he was up to 18 billion, which for a startup himself, for a boutique investment company, was just incredible amounts of money. When he was doing this, when all the money was pouring in, yes, he was investing it in these, as I say, these sort of FTSE 100 companies he was known for. He was also as I said, very interested in the startup world, the biotech world. A lot of companies that were spun out from academic research from universities. He started investing in these, and he started putting in money. Um, the problem with these companies is that they are new, they are research based, they require lots of steady money coming in and coming in, and he was on the hook for that. But he kept writing the checks, $1 million here, a couple of million there, just to keep the ball rolling, just to make sure that these businesses keep going, and hopefully provide the untold the wealth and the valuations in the future they expected. This was all going fine for about 3 years, and then in 2017, summer of 2017 is very much his annus horribilis. The all his big companies, for various reasons, just started performing incredibly badly. This was a time where, as everyone will remember, the UK was getting very frothy about Brexit, and it didn't know what it was doing. Companies didn't have a direction what they were doing. We knew it was happening at some point, or we kind of knew it was happening, but the companies couldn't really plan. These valuations were really hit. The stock market took a pounding. This all heavily hit Woodford's funds. Investors started pulling out. So for the first time, you're starting to get people pulling money away from his funds, and he's thinking, okay, how do I pay them back? He's starting to get quite a large rump of unquoted companies, or very early companies, startups, which are very hard to trade. In the lingo, it's called liquidity. They were illiquid. He had liquid holdings, which are the big FTSE 100 companies. So he sold some of those to pay back people, and this kept going. The more people left, the more he had to pay back. It was a virtual circle. The more he had to sell his FTSE 100 companies, that meant a bigger rump of these illiquid holdings, and that affected the performance of the fund, and it kept going down, and more people left, and you had to sell more FTSE 100 companies, and so this was a 2-year process, and in that time it was in terminal decline. He could see it. He tried ever more funky, interesting, creative ways of kind of getting around this problem. The important factor here is that there are rules in European fund design that you can't have more than 10% of the fund in unquoted holdings for the sort of fund it was. He kept bashing against that level, because this small chunk of unquoted companies were getting bigger and bigger as a proportion of the whole fund. And he tried ever more creative ways to get around that. People were deserting him, and it all came to a head in June 2019. The last of his big clients, Kent County Council Pension Fund, withdrew £260 million. He didn't have the money to pay them back initially at one go, and he's forced to suspend his biggest fund, and that brought on the biggest fund management scandal, certainly in Britain and maybe in Europe, since the financial crisis. And that's very much what my book deals with.
Ashley, you're on mute there. Sorry.
Apologies. Hi, how are you? Thanks for that, Owen. I just wanted to follow up on that, and I suppose you'll delve into this a little bit later. But when did you realise, I suppose, that there was a story here? What point did this kind of come to your attention, come to the news desk, and when did you realise that you really needed to write more about this and bring it to the attention of the public?
Well, I mean, me personally, when Woodford's career had been on this incredible trajectory at Invesco Perpetual, and when he left Invesco at the end of 2013, launched his new company at 2014, that was a huge story at the time. And certainly in the investment sector, it was the biggest story. And even in British business, it was a really huge story. I happened to be living and working in New York at the time. I was covering US investment companies. So for me, it wasn't something, I mean, I was keeping an eye on it. But for me, I was more concerned about what the impact would be on Invesco, which was a company I covered in the US. So for me, it wasn't the biggest story for me at the time, and I didn't come back to the UK until for a couple more years. So in that period when he launched 2014, and when he was growing the business and getting bigger and bigger up to 2017, that was a story I was kind of away from at the time. By the time I came back and my role changed, and I was covering European fund management companies, as I said, his business had started to turn. It became one not of success, but one of decline.
Mm.
But from the minute his business started, there was intense media scrutiny of everything he did, whether it be whether he invested in a new company, whether he sold a company, whether he, whatever it was. There was a new funding round for one of the startups he had invested in, and I just kind of naturally fell into that rhythm of all journalists kind of just following this guy because there was so much interest in him, because
Mm-hmm.
hundreds of thousands of UK investors were investing in his funds. So I was kind of following that story. But from, as I say, from about 2017 onwards, there was a lot of skepticism within the fund management industry about what he was doing, about his investments in these unquoted companies and these startups. A lot of traditional fund managers were looking and saying, look, he's very well known for doing this traditional stuff. He's got 25 years, incredible, an incredible sheet of results for that whole period. He's now doing something completely different, which in the fund industry, that's a huge red flag. if
Mm-hmm.
if you're known for doing one thing in a certain investment strategy, and just continue to analyze companies in one way, and suddenly you're switching to something completely different, that is a big red flag. So we were getting lots of people in the industry, people we knew. We were getting anonymous tip-offs, people saying, you should be really keeping an eye on this guy, what he's up to. He may be having an okay time at the minute, things might be starting to turn for him, but actually, if you look under the hood, if you look at actually what he's got, what are those holdings, which aren't the top 10 holdings, aren't even probably the top 20 holdings, but further down, there's an awful lot of very strange investments he's made here that he doesn't really talk about that much, but actually that's the important stuff, and it got bigger and bigger as a proportion. So we were kind of tracking this and following it and doing the odd story and digging into it a little bit, but then things really came to a head in late 2018, early 2019, and that's really when we realized that the business was in terminal decline, and there was no way back, if you like. So, I was speaking to a lot of the investors who invest in his funds, people like Kent, and sort of thinking, how long will you be invested? I'm not saying you should be pulling out, but you still very confident. Kent were his biggest fans, so they were very loyal to him. Um, this kind of culminated. Myself and a colleague wrote a story in late May 2019. We did a story, and it was front page of the FT, and everyone else picked up on it. We looked at the shocking decline in his fund over the previous, I think it was 3 weeks or 3 or 4 weeks. It collapsed by about a third. That was a combination of people pulling money out, but also the really poor performance his fund was having in the markets, and that alarming rate of decline had alerted the FCN. The FCA by this point was very seriously concerned about what was going on. Was having regular phone calls and conversations with Woodford and some of the other people involved in that fund, to really get a handle on what was going on here, and where it could lead. And we did that story and said, alarming decline, and the regulator is also very concerned. That was front page. I said the next day, Kent County Council had this trustee meeting. They looked at that and they thought, we don't want to be stuck in this fund if it's suspended. We want to take our money out. And then the following week, that's when the money, the request was made to pull all that money out in one go. That's not what they had agreed the previous week. It was actually a mistake that went through in that way,
Mm.
and the fund eventually suspended. So that's kind of how it all came to a head. But there were definitely warning signs about Woodford and the way he was managing his fund for 2 or 3 years, I would say, before it eventually collapsed.
And I suppose you mentioned there that there were hundreds of thousands of investors involved. And I suppose I just wanted to delve in a little bit more into that piece. You give some really good examples in your book of how it affected ordinary members of the public, as opposed to large institutional investors. Can you elaborate a bit more on that for those of us who haven't read the book, who might be on the call?
Sure. So, I mean, as I keep saying, Woodford was the best known UK fund manager, and when I was researching the book, there just became more and more examples of just how many people in the UK had not only heard of him, but also invested in his funds. When I was talking to sort of friends, colleagues, colleagues at the FT, and even relations, about what I was up to, what I would be, working on this Woodford story, often they'd say, "Hey, I've just realised I'm actually an investor in Woodford. I use Hargreaves Lansdown, which happens to be the UK's biggest investment platform. Um, I'm a customer of theirs, and through doing that, they've kind of sort of convinced me that investing in Woodford's a good idea. So I've got part of my pension in there. It's not something I ever really considered before, but uh, you're kind of the fact that you're looking into this is something that makes me think, oh, I'm actually one of these people that's trapped. We don't know the exact number of people who are trapped in these funds, and bear in mind these people have still got their money trapped in these funds. Um, but it's at least 300,000. That's a floor. I would guess it's closer to 400,000, if not more. Um, and when this became a really big story in UK politics as well in 2019. A lot of there was a whole stream of sessions in UK Parliament. The Treasury Select Committee were pulling in an awful lot of people to talk to them about what was going on. People like Mark Carney, then Governor Bank of England, Andrew Bailey, now Governor Bank of England, who at the time was head of the Financial Conduct Authority, and various people in the industry to ask them, what happened here? This is under your watch. How did you allow this to happen? And I remember watching one of these sessions, and it started off, and there were, say, a dozen MPs were on the committee, and two of them started the conversation by saying, before we continue here, I would just like to say, I am an investor in this Woodford fund, and I am a client of Hargreaves Lansdown. And I think that just showed, of 12 people on this committee, two of whom were involved heavily in this story and were investors. And a lot of people would say, well, these are rich people, and this is their kind of their money they've set aside, and they've taken this risk, and if they want to do that, that's their problem, and they've taken that risk. That may be the case with a lot of people. Maybe for some people is a little bit of their savings, but there are also a lot of people who were convinced that they should put all of their money in, or at least a lot of their retirement fund. As an example, it was the Woodford Fund was the default retirement fund for the people within Woodford Investment Management, within Woodford's company. When his company closed, people lost their jobs, their pensions were all trapped in this fund. So there's a lot. I mean, yeah, it was maybe 30 or 40 people there that affected. But also I found people like Fred Hiscock and Pauline Snelson, two people I mentioned in the book. They were a couple in their 60s and 70s living in Salcombe in Devon. They're still working. They were looking forward to retirement. Fred's in his early 70s. He has to supplement his pension with driving buses part-time, and Pauline runs a B&B full-time. These are people who are expected to retire by now, but they admit they made some poor financial decisions. They had put their entire life savings in Woodford's funds. This has all been chewed up for the last few years. Because of that, they've had to delay retirement. They've had to admit that they won't be able to pass on anything to their grandchildren because of what's happened here. So their inheritance that they were looking to pass on, that's gone. And I suppose the most galling thing for them is they live in Salcombe. As I say, Pauline runs this B&B. She says she can walk 2 or 3 streets down to the bay. Salcombe's a very picturesque little harbour town. Neil Woodford just happens to own a multi-million-pound holiday flat overlooking the bay, and she sees it every day, and it's a daily reminder of what a bitter experience it's been for her. So there are real life consequences to a lot of this kind of finance and these terms that we throw around. That's the real outcomes.
Okay. I suppose maybe we've had 1 or 2 questions come in on, and I think they're kind of on a similar theme, and they're around. You've already mentioned I suppose what caused the issue in the end was these unlisted stocks, and I suppose one question that's come in kind of is around, like, at what percentage did they end up with? Like, okay, we had to push up against this 10%, but at the end, do we have any sense of where they actually were? We up at 20, 25 or whatever? And then in the same breath, where the question asks about a depository, but I think in the case of the Woodford stable of funds, there was an unauthorized corporate director who was supposed to kind of oversee this, and how come that particular control mechanism did not kick into force?
Excellent. Yes, good questions. Sarah, so your first question on the 10% level. This is one of the really interesting parts of this story, because if you look at the rules, 10% unquoted, it says. So that means that obviously they're not quoted on a stock market. They are companies that are private. They don't have shareholders. The reason there is this 10% limit is to stop this illiquidity problem that Woodford eventually found himself in. Now, you could be listed on a very small stock market, and you could have one shareholder. Your shares aren't liquid. It doesn't mean anyone wants to buy those shares. There's not a willing market for them. That's still an illiquid holding, but by the rules, that counts as being a liquid or an unquoted company, or a liquid quoted. So there are lots of ways of kind of getting around this, and this was one thing that Woodford did. Now, another thing that he did is, under the rules, if you say you're a company in there, you're a private company, but within a year, within the next year, you intend to list, you are then classified as being unquoted. As being quoted as being a listed company, even though you're clearly still a private company. So what Woodford did to try and skirt this rules, he convinced 2 or 3 of the holdings to say, why don't you say that in 1 year's time you intend to list on the Guernsey Stock Exchange, that very well-known, globally high liquid, stock exchange, Guernsey, where all those international finance houses are going in trading. There is very low levels of trading in Guernsey, but by the rules of the fund, by the rules, it was able to say, these companies were able to say, in 1 year's time, we intend to list on the Guernsey Stock Exchange. And that basically meant all those companies were, I mean, there's only 2 or 3 of them, but it meant that those companies moved from the unlisted section of the portfolio to the listed section of the portfolio, which gave him more breathing space. So there were several of these little tricks that he did. I mean, bear in mind, I think of those, 3 or 4 companies, I think only one of them eventually listed in Guernsey, and then they eventually are delisted. So you do have lots of tricks. So he did come over that 10% level on 2 or 3 occasions, and it would be by the letter of the rules, he was going up to sort of 12, 14%. But if you kind of step back and say, well, actually, let's say if you intend to list somewhere, let's say you're not listed, let's say you're still unlisted, and let's say, excuse me, if you're being moved into other pots within the fund company, you're still listed. He was getting to at least 20% of the unquoted. That would probably be 22% would probably be the high point. And now if you look at the fund, it's I mean, what's left of the fund, it's not really a fund anymore. It's being liquidated. It's pretty much 100% is unquoted, because that's the bit they can't sell. There's not a market for these holdings. And then on the depository question, yeah, it's a very good point. The depository, the fund had a depository, and the fund also had an authorized corporate director. And to Paul's point, the depository, excuse me, I'm just going to have a quick drink. The depository and the authorized corporate director had a big role here in ensuring that the fund was playing by the rules, that the holdings were in the correct categories, that they were within the rules of the fund. And unfortunately, what you had with the Woodford case is you had depository and also an authorized corporate director who were too willing to go along with what Woodford, the superstar fund manager, wanted to do with the portfolio, and weren't willing to stand up to him. Excuse me. And I'm aware that the depository was maybe a little bit more willing to say, I don't think we should be doing this. This isn't something we should be doing. But they didn't provide sufficient response to Woodford when he said, no, I'm doing this, it's within the fund rules, to push back. And my understanding also is that the authorized corporate director was the way they operated was they very much went by the rules. They didn't particularly think about, and this is something, a phrase that Andrew Bailey at the FCA later said, that the fund was run by the rules but not in the spirit of the rules. So if you took a very straightforward view on the wording of what the rules say, the funds didn't necessarily break the rules, but actually, what's the spirit of rules? Why are there liquidity? Why are there caps in there for unquoted holdings? It's to protect liquidity. A lot of the chicanery that was going on had no impact on the liquidity whatsoever. All it was doing was just moving certain stocks into certain baskets within the fund portfolio, keeping the fund going, but not addressing the key problem, which was the liquidity. And that's why there has been some looking at the role of the ACD in this, the ACD market, the role of depositories, but also the fund rules, which say 10% unquoted is what you're allowed. When actually maybe you should be thinking about the amount of liquidity those stocks have.
And has there as of yet been any scrutiny then on all those fund services provider that has kind of had any kind of tangible impact on the industry and how it operates?
The FCA carried out a industry review of the authorized corporate director market. Now, as I'm sure your viewers will know, the authorized corporate director plays a kind of a key role in fund administration. By law, they are the fund manager, even though the portfolio manager, in this case Woodford, is better known for sort of picking the stocks and arranging portfolio. It's the authorized corporate director who, from a legal perspective, is the person who, or the entity which acts as running the fund from a compliance perspective, from a regulatory perspective. It's their role to ensure the fund is run in the best interests of the end investor. Now, the FCA looked at the market for authorized corporate directors on the back of what happened with Woodford, and it concluded, well, it was a fairly anodyne, I would say, investigation, but it kind of covered top lines that there were parts lacking. They are still investigating. There is an ongoing investigation to what happened with, as you mentioned earlier, when we're coming up to the 3rd anniversary. They still haven't published their findings from that. They are looking very closely at Link's role in this, Woodford's role, other people involved in the fund's suspension. So we might hear a little bit about what they think the authorized corporate direction in this instance called Link, what their role should have done, what they should have done differently, individuals there, whether they should have acted differently at various points in this saga. So we're still waiting for those findings to come out. And until those happen, I don't think we're going to get close to a proper look at how the industry and how the depositories and how the authorized corporate directors, what they should have done differently. That is being dealt with this FCA report. As I say, hopefully we're getting close to it coming out. There was some discussion over Christmas about the Treasury, the FCA was saying we're still getting close to it coming out, and then the chair of the Treasury Select Committee wrote an open letter saying, that's fine, but hurry up. You are on watch because this is taking far too long, and there's lots of people's lives savings are kind of very much in the balance here. So we haven't quite got there yet. Hopefully, maybe in a year's time we can come back and talk about what those longer implications are.
Mm-hmm.
Yeah, and I suppose we have a number of questions after coming in from a few of our audience members, both mainly on the Q&A, but also in the chat. And one question that's come in is, what is your broader view of the recent proposals to, I suppose, loosen those restrictions for UK pension funds to invest in unlisted investments, such as private equity, given that this situation occurred when there was a loose interpretation of the rules, as you mentioned earlier, was said. So do you have any thoughts on that, and whether there are lessons actually to be taken away from this scenario that should definitely be borne in mind when considering any such loosening of restrictions?
Yeah, I mean, the problem here, the problem with this, and I think, stepping back, I think as investors, I think it's important to get, diversity. That's the big key word, and the other one is knowing what you're investing in. You shouldn't just be investing in anything. If you're going to invest in private equity, you should know exactly what the characteristics of that investment are. It's not something you're going to get a nice 10% return on next year. Often private equity investments are something you're locking your money up for a long time, and it is, to an extent, it's perhaps a higher risk, um, but maybe higher gains as well. So if you follow those two rules, that you know what you're investing in, and you know how it's being managed, and you are diversifying, then I don't see any reason why you shouldn't be thinking, be it pension funds, or I don't think individuals, unless you're going to be investing in private equity or hedge funds or anything of that nature anytime soon. But the idea of diversity and knowing what you're investing, if you kind of keep those two as a mantra, then there's no reason why you shouldn't. What happened with the Woodford case was, it was essentially um, a fund which was masquerading as a fund to invest solely in listed companies, which was designed to do that, which people were invested in from the start, thinking it would be invested in large blue chip companies, which ended up not being that, and there was invested in a lot of companies which really didn't fit that criteria, which introduced high levels of risk, which introduced longer investment horizon periods, lack of liquidity, ongoing funding requirements, all these elements which you wouldn't expect if you're investing in GlaxoSmithKline. You're not expecting GlaxoSmithKline to come back to you every 6 months, say, can you give us another couple of million quid just to kind of allow us to keep the research department going, or I'm afraid we're not going to hit our dividend this month, or we just get GlaxoSmithKline pays great dividends, and it can be relied upon to do that every 3 months, 6 months, whatever, and that's what you're happy with. If you're investing in a fund which is designed to do that, that's what you're expecting. You're not expecting to be kind of left holding. And if GlaxoSmith disappoints, you can sell it tomorrow or sell it this morning, and it's gone, and you've got your money back at the market rate. Whereas, if you're holding, WYSIWYG medic.com company, no, people aren't necessarily going to be buying that. And if you are, it might take several years to sell that. So yeah, in short, I don't have a problem with a wider range of investments being taken. I think you just need to know exactly what you're investing in, and how, and that funds are structured to be able to cope with those different demands of liquidity. So if you're a long-term pension investor and you're thinking, I'm not going to touch this money for 20, 30 years, yes, maybe you can afford to have a little bit in private equity or hedge funds. But if this is your rainy day fund, and maybe you might need to access it next year to to fix your leaking roof, that's probably not a good thing to be investing in.
Yeah, sure. Yeah. I suppose, I guess I can see a question from Brendan, which I think looks at the, I guess the final kind of moments of collapse, and I suppose maybe you might convey for us all there was a bit of a kind of a difference of opinion as to maybe what should happen at the end. Should the fund be effectively closed, or should it be allowed to kind of do an orderly kind of sell off of the portfolio, with, I guess, Woodford probably more in control of events. And Brendan's question, I guess, is a bit more around that, and also looking at the kind of this gating. Once a fund gates, is it effectively the death knell for the fund, or can they actually recover from it? Kind of a more broader type question then as well.
Yeah, no, I think people often see a fund gating as a big warning sign that the fund's in distress. Now, really, all gating means is that at the current level of outflows, and also you can gate for inflows. You can sort of say, we're not going to accept any more cash, because the money we have in this portfolio, we can't allocate it to the sorts of things we want to do. That's quite rare, because you're not going to get too many fund managers saying, stop giving us your money. What's more likely is, and actually, there is an argument that Woodford should have done that in the early days and say, look, we can cope. We're a very small outfit. We can cope managing 2 billion. we probably can't cope with managing 5 billion now, or 10 billion, or 18 billion. And so maybe say after, first 2 or 3 billion, say, okay, we're gonna gate the incoming flows for the meanwhile. We'll assess the portfolio, make sure we're happy with that and our systems, and then we maybe let in some more money in 6 months' time. He was launching a new business. He wanted to keep the momentum going. He wasn't, and very few fund managers are going to do it. You have to respect the ones that do. Gating on the way out, that is, as I say, it's a bit of a warning sign that the fund manager is failing to cope with the amount of money going out. But it doesn't, I wouldn't say it's a death knell, because all it means is you're asking for a bit more time to be able to sort out what's going in the portfolio.
Yeah.
And if in your mind you're thinking the reasons that the portfolio is under stress at the minute are short-term reasons, and the question about the Irish real estate funds during gated is a very good one. We had very similar in the UK after Brexit, and also after COVID. Brexit happened. The first thing people did in the markets were, well, I'm going to pull all my money from UK properties. Property market's going to implode. No one wants to touch post-Brexit Britain. What's my proxy for doing that? I'm going to take money out of property funds, real estate funds, and lots of people did that in the sort of the weeks immediately following the Brexit vote, and as a result, several, I think about half a dozen at least, of these multi-billion-pound UK property funds gated. And they all reopened. None of it. They all stayed. They're all still open now. I think several of them had to gate in COVID a couple of years ago. They reopened. This was, if you're dealing with real estate, if you're dealing with property, that is inherently an illiquid asset. It's very hard to sell day to day. You're looking at much longer term horizons, and if you have that imbalance between the time at which people want their money out, and the times which you can buy and sell those assets, you've got a bit of a problem there. And this is actually what the crux of the book is. Built on a Lie was what Mark Carney described, that situation where you have funds which are designed for people to take money in and out of any day, but they hold assets which are sort of tied up for several years. So gating can be important. It doesn't necessarily say those funds are going to close forever, though there are lots of high profile examples of when they do. You've got Woodford, you've got GAM funds a couple of years ago, which was that's a particularly big saw. And then a couple of years last year, in fact, around this time, you had Credit Suisse, and they had a range of funds in their asset management business tied to Greensill, or supply chain finance funds. Those funds suspended, and then they eventually closed. So yeah, often it does lead to closure, but not all the time.
That's really interesting, Owen. And I suppose just to kind of wrap up, as I'm conscious we're coming to the end of our 50 minutes, we've a lot of fund service providers on the line from a wide variety of backgrounds. And I suppose I just wanted to ask you if you have a couple of I suppose, bite-sized takeaways that you think are kind of really helpful, that you've kind of learned throughout the process of your very in-depth research for this book, that you think are kind of important for people in the industry to always kind of keep in mind, having learned some lessons as such from this whole situation.
Yeah, I mean, I think one lesson which I think has been learnt in the industry, but I think it's one that kind of comes up every now and then. There was, and this story really highlights is the idea of the kind of key person risk, if you like, within fund management, within the fund management industry, where you did have these star fund managers who really were bringing in a lot of assets in the sort of the 80s and 90s and early 2000s. And then they would often have problems. Either had a bout of poor performance, or maybe they moved to a different fund management house, and often those assets either they walked out the door when that happened. And I think that's one lesson the fund management industry has learnt. It is to move away from the individual to the collective, and I think that's something that may rear its head again. So that's probably one big story, one big learning from this episode. Another is just the, again, it's another it's a lesson which, whenever there's a sort of scandal of these types come up, people always rush to sort of remember that liquidity is one of the most important aspects in fund management, and quickly gets forgotten, because I think if you trace back most of the big fallout, scandals, problems in the investment industry have all got something to do with liquidity. Often it is this very nature of people looking to pull all their money out at one time when the funds can't cope with those. So I think there is being some learning going on about the example of the real estate funds. I think there's definitely some learning about how they should be structured, whether there should be longer lockup periods in terms of accessing your money, whether you should be able to access them on a day-to-day basis. That's an ongoing conversation in the industry, and I think that's something that there is some learning from it. Will this be the last sort of problem with liquidity in the fund management industry? Undoubtedly no. Whenever we get, we'll probably be here in 2 or 3 years time talking about the latest scandal, and I'm sure liquidity will play a key part of that. And then maybe finally just looking at the kind of the importance of that authorized corporate director within the role, and this was a group of companies, a kind of a sub industry within the fund management industry, which no one had heard of outside the fund management industry, and to be frank, not that many people had heard out within the fund industry. These were people who were kind of dismissed as back office administrators, which this story really showed how important they were to the whole ecosystem of the fund management industry. And I think that they had been neglected, and I think that maybe led to some practices that went under the radar, which weren't really in the best interest of end investors, and maybe they were sort of seen as kind of just an admin function which hasn't got much to do with it, and we can really kind of let them get on with it. What actually maybe this highlights the importance of those players, and really there should be more of a focus on what they're doing and whether they are acting in the spirit of the law as well as within the rules, or just very much within the rules.
Thanks, Owen. I think that's a really helpful, I suppose, summation of some of the key takeaways. And if anyone obviously wants more information, thankfully there is a whole book on what you've been talking about today. As John mentioned at the start, Built on a Lie, it's an excellent read. And I think one of the key takeaways that I had from it was just the impact on the individual and how important it is to understand where your money is going, etc. So I think John rightly said that you don't have to necessarily be in the financial services industry to get a lot from your book. So it is excellently written and excellently researched. And also, thankfully, Owen was kind enough to give us some time recently on our podcast, It's Fundamental, which will be published on our website in the coming days for anybody who wants further information. And we actually delved into a variety of other topics on that. Owen kindly talked about various elements relating to fund managers and I suppose this key person risk. We delved into that a little bit more on that podcast as well. So that will be available for anyone who wants to hear more about that. So thank you so much to everybody who attended. Thank you to Owen for giving so generously of his time to speak to us. And thank you to John, my co-host here on today's webinar. We would be delighted if anyone had any feedback to get in touch for future seminars. We'd be more than willing to incorporate you into our calendar. And as always, more information about our masters and our other programs are available on our website, fundsacademy.ie. So thank you, Owen, and thank you again to everybody who attended. We really appreciated it.